What do you, I mean, I guess everybody kind of senses, even as we reopen, it's going to be difficult for a while. It's going to be almost as hard to reopen, if not harder, for a lot of industries.
I agree with that. I mean, there will be a V here in the next couple months as we at least get a partial reopen. But I still think that the rebound is going to be to much lower levels. And I mean, really, 10 out of the last 11 years, we've had negative real interest rates. I mean, that's put into place at the end of the cycle a lot of malinvestment. And obviously, energy is the poster child for that. The oil patch is the poster child. But we're going to find out more now that the tide has gone out. And I think, so, even if this were to completely blow over, and I'm talking about the health scare, we've still got economic excesses to work off, and it's just going to take some time. We're not going to do it with a 27 trading day decline in the S&P 500.
Brian,
so I think we're going to see those lows tested and, in fact, taken out later this year.
Okay. Do you agree with that, Brian? I mean, it's pretty obvious. I think all of us have had this experience, right? You start to get notes from your doctor's office, from your dentist, and you look at the procedures now and the staffing requirements and the way it's going to be to even just go back to an appointment that simple, and you realize we're going to be dealing with a new normal for a very long time.
No, Kelly, I think that's right. I mean, you said earlier, is it a hangover today? I think a little bit of this is exhaustion, right? I mean, the stories that are coming out are the same information rehashed in different ways, and the truth is no one knows exactly what this looks like. And so how does that translate to markets? Well, investors get too optimistic, and then they realize it's not happening as quickly. In fixed income, that's okay because we earn income, right? A lot of our securities are meant to do very little. So I think for investors looking for fixed income, there's plenty of opportunity. But the idea that you're going to wake up and having missed it, or having this whole cycle being over in some brief period of time, is, I think, a bit of human optimism as opposed to reality. I don't blame people for it, but I think you have to take a deep breath and realize we don't know what this looks like on the other side. Timing, valuations are difficult to ascertain.
Yeah, Brian, I was looking at your notes. One part of the market you really like is a part that's really hard to access, and no coincidence, those go hand in hand. You like investment-grade securitized assets. Like you said, there's no ETFs. There's not even any Fed programs. There's great income. So for sophisticated investors, they can maybe access that. For the rest of us, how would you recommend gaining that kind of exposure, or would you not? Is there no other kind of really good play available right now?
Well, it's interesting. You look at investment-grade credit, right, and everyone says follow the Fed, and everyone knows that, so it worked. If you look at the yield of the investment-grade corporate index, it's back pretty close to where it was in February. Now, treasuries are lower, so I'm not saying the yield can't fall. But if you look at securitized assets, they exist. You can buy them in active fixed income funds and go anywhere funds, but the yields on those are more like 6, 7, 8%, and there's risk in them. Don't get me wrong, but since they can't be accessed as quickly by the Fed, I think it is a place where there is still value and income, which is very valuable in an uncertain environment. It's where fixed income should play a good role in a portfolio.
That's interesting. So what you're saying is it's taking the Fed long enough to get access to that part of the market that investors can front run them.
I'm not sure they're going to come into every market, right? Nor should
they
have
need to. Right, exactly.
Right.
But that's leaving more spread than some of these other places where they have.
That's right. It can't be that all the Fed stuff is okay and everything else is bad, right? There should be some gray area, and that's where I think you want to invest right here.
Yeah. Doug, this morning, David Faber was talking with a banker at J.P. Morgan who made a really interesting point, kind of to what Brian was saying, that there's a Fed put in everything now, officially or otherwise. Does that frustrate you? I know that you think one part of the market in particular that's overvalued is large cap and large cap technology, saying by your measures they're higher than all but 2 historical bull markets. But does it matter if everything's rising because of this Fed support?
I don't know. We certainly have some examples in Europe and in Japan where rates are even lower, in fact, negative in many cases, where PEs are much lower. So we've kind of battled that argument that these very low capitalization rates you see in the risk-free rate should account for much higher PE ratios. I don't buy it. I think those extremely low rates are a signal that we've got serious problems here. And in fact, that was a signal that was in place prior to the coronavirus erupting. So I don't buy that argument. That being said, if we do go back and get anywhere close to those lows, would not surprise me at all if the Fed somehow legally or otherwise finds a way to maybe buy these equity ETFs. I mean, Japan's done it.
Yeah.
What I'm getting at here is even the bears, I think the bears ultimately will be pretty satisfied on this thing, but it's going to be a choppy road because you're going to have those flashes of hope, I think, engendered not just by the Fed, but by other policymakers acting in tandem. But I think ultimately we're going to drop to some type of fair value. And just in terms, you talked about the valuations at the bull market highs. If we were to fall to the most expensive valuations ever seen at a bear market low, we would get down to close to 2,000 on the S&P 500. And I don't think that's necessarily an unlikely thing by the time this thing is all over. I know it sounds draconian, but again, that would be the most expensive valuations we've ever seen at a low.
Okay. Yeah, knowing everything you're saying about the Fed, the stuff that used to sound crazy and conspiracy theory is now seems very normal and people talk about it all the time. Doug Ramsey, Brian Weinstein, thank you both for some good thoughts on these markets.